Welcome to the Real Estate Investing Club. This is the place everyday real estate investors gather to share their best stories, biggest insights, and favorite tactics to grow a portfolio of cash-flowing properties in today's market. Here's your host, Gabe Peterson.
All right, we are back with another episode of the Real Estate Investing Club. I hope you guys are having a great day, a great week, wherever you are and whatever day it is for you. As always, on the podcast, we're bringing that Friday energy to you. And I do have to apologize. My 2-year-old daughter got me sick, so I have a little bit of a voice today, but we'll get through it. It's going to be a good day though, because we got a less talked about asset class, I guess I'll say that, on this show today with Joel Friedland. He is with Brit Properties and they buy industrial. Industrial, as you guys know, I've mentioned this on the show. I've always been kind of interested in it. I don't know why. It's like big self-storage for some reason. I really like the idea about it. So I'm super excited to jump into this, learn a little bit. Joel has a ton of experience. He's been in it since, I believe, if I remember what you submitted, Joel, 1991, I believe, is when you first got in. So you've been in for a while, a lot of wisdom to jump in. Joel, thanks for hopping on the show.
Thanks for having me, Gabe. Actually, I started as a real estate broker, an industrial real estate broker, in 1981 when I was 22 years old. I worked for a family business, but it wasn't my family, that owned 80 industrial buildings around the Chicago area. And they trained me as to how to do leasing, selling, and syndicating. So
very
cool. Great. It was amazing. It was a father, 2 sons, and a daughter, and they took me under their wing like I was a family member.
I've mentioned this. Yeah, I've mentioned this on the show a few times. Like, I wish I had that kind of start where you kind of get to be part of a small family office that's buying a certain asset class, and you just get to learn. I mean, I bet in those 10 years, you learned everything there was to know about industrial.
I learned as much as I could, and then in the last 30 years, which is a long time,
you learned the rest.
A lot more. Many lessons. Yeah.
Nice. Well, let's get into those lessons. We always like to start with stories. We like to hear, how people got from where they started to where they are today. You already kind of gave us the beginning of that story. You worked with a family office. You were a broker doing leasing, that kind of stuff. So tell us how it's gone since then. Like, what has your career trajectory been?
Well, I left that family in 1991. That was the year that I started my own business with a couple other guys. And I stayed close with the family, by the way. I still am close with them. It's really important for me to have long-term relationships. And that's really the thing that I would say is the essence of who I am. I'm 66, and I do whatever I can to maintain relationships with people and investors. So I've started putting my own syndications together. And since then, I've acquired 107 industrial buildings, probably about $300 million worth. And to make it simple, I have about 300 investors, and they go back with me as far back as 34 years. And we've sold 82 buildings, so we currently own about 25 buildings. And the biggest thing that you need to know about industrial is that there are many kinds of industrial. When you drive by an Amazon facility on the side of a highway, that's called big box or Class A. And what I buy and syndicate are what are called small box Class B. Every town in the world has industrial parks. There's usually an industrial drive. It's the old industrial park. In the newer parks, they have fancier names, and they're curvy streets with ponds, and they're called business parks. The key thing about industrial Class B small buildings is in Chicago, it's a lot of manufacturing. So of our 25 buildings, we have about 17 manufacturers who have big machines that people who are very well trained. The labor is well trained, technical, and they make parts for aerospace, for medical, all kinds of things, anything and everything that is in your home or your office or your school. or your hospital is made in an industrial building and then warehoused in an industrial building. That's the background. And these are usually longer term leases, unlike self-storage where someone can get out of the lease. Tenants sign leases with us for 3 years, 5 years, 10 years, 15 years. We had a magnet company that was in a building of ours in a town called Elk Grove Village, which is near O'Hare Airport. And they manufactured magnets for industry. Magnets are in everything. Magnets are in your computer. Magnets are in your car. There's magnets everywhere. Who knew? And they would manufacture those magnets in their building, and they signed a 15-year lease because there's so much equipment they can't afford to leave. And the rent goes up every single year. Goes up usually by about 3%. So we start out with our investors, our limited partners, making 7 or 8% as a yield. And over a 15-year period, it probably averages about 9.5% to 10%. And we hold them very, very long term. We're like a family office ourselves. Our investors are with us. It's their way of, instead of being in a short-term 3 to 5 or 7 year deal, of actually feeling like they're part of a wealthy family that never sells. And so if people want to get out of our deals, they call me and they say, I'd like liquidity. And because we have so many investors, I can make a phone call and get them out in one day.
That makes sense. That is actually a point that I never really thought about, is that if somebody, the advantage of having been in the game for so long, you have, 300 investors who've invested with you. It gives, it's an advantage for the people, new investors coming in, because if somebody's in the pool and they want to get out, those new investors will be able to take their place. And so it like you said, it allows liquidity in the investor pool that's already engaged in these, 15-year investments. So yeah, that makes a lot of sense. Are you, while you're talking, a lot of questions kind of started popping up in my head. One of them, you mentioned manufacturing. You guys like investing in you said B class. I don't know if that's specifically what it's called, but the B class type of industrial. And you kind of broke it into two categories. You said manufacturing and warehouse. This has been a real big push for the current administration, is getting manufacturing back to the United States. Are you seeing that in the, on the ground? Is there an increase in demand?
Not yet. It takes years and years to set up a manufacturing operation, and the planning that goes into it, the strategy is a years-long process. We won't see any of this for 4 to 5 years if it happens. But I want to tell you one more interesting thing. We do all of our deals debt-free. We don't borrow money.
Oh.
We don't like banks. We're very conservative. Our investors don't want to lose money. In 2008, I had 50 buildings, Gabe, and 10 of them were in trouble because of the global financial crisis. And I was into the banks for $70 million worth of personal guarantees. And I was in a position where we had to sell buildings that we didn't want to sell just to survive. And it was a really, really rough time. In fact, I thought I was going to lose my house. I thought I was going to lose all my buildings. I thought my investors were going to lose all their money. And I decided to fight it out and keep things going and not let the buildings go down, not let the portfolio go bankrupt. And I worked it really hard. But for the beginning of the 2008 disaster, I fell into a depression because I thought I was a hot shot until then. Borrowed money, made a lot of money. My average return on 50% of our portfolio was 40% IRR.
That's not bad.
When the market's going up, even an idiot can make money. So a lot of idiots.
I actually have a story about that. And when I did my first flip, it was right in the hockey stick, and I thought I was a genius, but I just really did the flip at the right time. And it's just, I look back now, I'm thankful because I made, it was a single family, and I made $86,000, which I thought was like I could retire. And but looking back, you realize I could have done anything at that. I could have bought and not done a single thing to that property and then sold it. And because of the market, it really does make a difference. So that story that you were talking about, how you kind of, you got lucky with the market, that makes a lot of sense.
Yeah, and we did it with a lot of debt, so we were making a fortune. We were truly, we were artificial big shots. My partner and I. What happened was we bought fancy cars, fancy homes. We were like millionaires. I wanted to belong not to one country club, but to two country clubs because I wanted to have two different golf courses, so I didn't get stuck playing only one. Let me tell you what happened. We bought a building in a town called Niles, Illinois. It was a Budweiser distributor was moving out. We bought it for $3 million, and within 60 days, I sold it to the next door neighbor for $4 million. So,
Hey, not bad.
Okay, so then here's another one. We put a building under contract in Chicago during this crazy time when everything was going up, and we put it under contract for $3.5 million. And I found a buyer accidentally within a week after the contract. He came to see the building, and he put his hand out while we were walking through the building to shake my hand. And I said, "What's going on?" He says, "You're going to sell me your contract for $1.5 million, and you never have to close." I said, "What?"
It's a good wholesale right there.
He said, he pushed me against the wall, and he said, "Just say yes." And I said, "Well, we bought this to own it forever." And he said, "Just say yes." So I said yes. So in those days when things are really good, everybody wins. It's not hard. It's easy. And you can borrow as much as you want, and you can make multiples of your money because there's leverage. But in 2008, the lesson that I learned, so that after my depression and after being suicidal, truly not joking, because I thought my life was over, and that the headlines in the Chicago business paper would say, Joel Friedland fails spectacularly. And that I was going to be, I would be like, there would be a black mark on me for life.
Oh, geez.
And I worked really hard to keep the portfolio from tanking, but it took so much out of me that years later, when I started thinking about what the strategy should be next time so that that doesn't happen again, that's when I decided no debt. And I found out that there are investors who will go into a deal with no debt for the long term because they are freakishly risk averse. They don't want to lose any money. And I've got a group of those people, and that's today's business, is buying small Class B industrial buildings where the tenants don't leave, where the rent goes up every year, and not falling into a disaster if the market crashes, because right now there may be a bubble. I think it's a bubble. And if it crashes, people who have a lot of debt.
Specifically in industrial, or just when you say a bubble, what do you mean?
The whole country. Stock market. I don't know when someone's going to be watching this in the future, but if someone watches this, this will not age well if everything keeps going up and the stock market doubles again like it has in the past few years. But I don't think that there's such a thing as a tree grows all the way to the sky and never stops. There's going to be a downturn. And during that downturn, the thing that we're prepared for with this no debt program is, honestly, we don't rely on the bank being nice enough to finance. There's a biblical, it's in Proverbs. It says the borrower is a slave to the lender. It's biblical. It's true. And that's what I found in 2008. They owned me. Yeah.
So do you find, without using debt, and I like your strategy. I like the idea of not having debt. I don't like, we do a lot of seller financing. So we negotiate with the seller. We try not to take on bank debt. But I like the idea of no debt. It's really attractive. And I feel like it takes a lot of the stress out of the equation. But I feel like it would also be a little bit more difficult to get the returns a lot of investors want to see. Do you find that's still true, or
yes, you're exactly right. You're exactly right. If you throw lighter fluid on a fire, it could burn your house down. But if you put lighter fluid on your barbecue, it can make you a tremendously good sizzled steak. So that's debt. It can either really give you something fantastic with a great return, or it can take you down. And for sure, you're right. The returns with no debt are lower. And there's nobody else. I've looked. There's no one else in the United States. There's 4,000 syndicators approximately who have $100 million or more in assets. And we're just one of them.
Yeah.
And of those 4,000, there's not a single other one that I've ever come across who does debt free. We're unusual, and it does hurt. It hurts the return. There's no doubt about it. If someone wants an 18% IRR, we're not the guys. Because if you do shoot for an 18 IRR, you've got to be doing something that's risky.
Yeah.
Yeah.
We're
lucky to make 12 to 14% on a good deal. If we own it for 20 years, think about it this way. If the value of the building goes up 5% a year, that means that it doubles in 20 years. So 5% a year. If we own it for 20 years and our average cash flow yield is 11 and it goes up 5% a year, just straight math, it's a 16% return. We don't often do that well. Usually the buildings go up on average 3% a year. So if our average over 20 years is an 11% cash flow yield, it brings us to 14. And that's not a 14 IRR. It would be a 12 IRR because IRR has the time value of money. I'm talking about just average annual return. 12 to 14 12%. Safer is what our guys like. But I can't pull the trigger after what I went through on a riskier deal. And I don't think anyone else should do this. I don't think people should invest only in safe things. You need to take risk. So people who go in with someone who's got the debt like you do, I strongly support that. We're just for like the little corner of somebody's portfolio that they want to have super safe for cash flow, and everything else they should do with a lot of diversification and take more risk, especially if they're as young as you are. I'm 66. And at my age, I just don't want to end up living in my kid's basement because I blew all my money being too much of a risk taker.
That's totally reasonable. I understand. So you've mentioned you've done, I think you said 100 and something deals, 110, but you've sold 80 of them. How do you know? I actually just recently went through this. There was 2 small self-storage facilities I had owned, one of the first 2 that I bought, and I had just held on to them, but my return on equity was really low because I bought them for such a good price. And I realized that, the cash flow they were spitting out was nothing compared to the equity that was sitting in the deal. And so I finally, after years, decided to sell these things. But even then, it was really difficult to get there because I was always, I always hear all the other investors saying, "I never sell, never sell, never sell." But you've sold actually the majority of your portfolio at this point. So how do you know when the right time to sell an individual asset is?
It's so hard. It is such a difficult decision to make. We had a building in a town called Schiller Park, and we bought it in June of last year for $1,140,000. And we have a tenant, and the tenant's been in there. They do delivery for the Gap. That's their business. Instead of going to UPS, the Gap has individual regional delivery companies, and they save money that way. So it's a good company. They have 14 locations around the Midwest. Chicago is just where they have a few of them, but they're in Indiana and Wisconsin. So we got an offer from a developer for $1,750,000. Remember, we bought it for $1,140,000. So you look at that and you say, okay, we've had it for a year. Should we sell it?
I would be hard pressed not to take that offer.
We didn't sell it. But boy, my partners and I struggled. We had meetings, we had calls. It's like, oh man, it's so much. It's so much. The tenant's lease was coming up, and we called the tenant and we said, are you going to renew your lease? And we told him that his rent increase was going to be from $6 a foot to $9. He said, go fuck yourselves. We're moving out. And so we thought he was moving out. So we start negotiating to sell it to the guy at the $1,750,000. And the negotiations got dirty because their lawyer was impossible. And it was really, when I say dirty, I mean just messy, messy.
Yeah. Yeah.
And we're
As
negotiating,
lawyers,
and they want to tie it up for 6 more months, and they want to do this and they want to do that. And ultimately, the tenant calls us back and says, "Hey, Joel, I went and looked at the market, and we made a decision. We're going to stay. We're going to extend our lease." So I had this buyer who was difficult. Their lawyer was difficult. And now, instead of having a building about to be vacant, I had a renewal from the tenant. So we had a meeting. We have an advisory board of 8 very smart people who invest with us a lot. And we said, what do we do? And they said to Eric and to me, we're the two managers of the LLC. They said, do what you want to do, guys. We'll take either one. And Eric said, I think we should keep it. It's still worth $1,750,000. We're just not getting it. It's still, like what you said, the equity was trapped in the deal, and to cash it out, you have to sell it. We think that the equity is still in the deal. We still think it's worth $1,750,000, but we're going to keep it and get the cash flow and maybe sell it another day. But imagine how difficult of a decision that is.
Yeah. Well, and that was the kind of what I ran into. Is I calculated it, and the return on equity for this deal, I think it was like 4%, because I just got such a good price. And so what I'd put into it was like pittance compared to what it actually turned out to be worth. But I knew that if I took that and I leveraged and, got bank debt and bought another property, took that equity, put it into something bigger, I could get a higher cash on cash return. And I ultimately decided to do that, but I just keep hearing, in the back of my head, all those people who say you should never sell a property. You should hold on to it until it's, until you're 99 years old. But yeah, I don't know. It's a hard decision to make, and I don't know if I made the right one. I guess time will tell. But yeah, I mean, you've decided to sell multiple properties, so I was kind of looking to see when do you know is the right time to sell? When do you personally decide that this property should be sold? Hey guys, quick break from the show. If you've listened to this podcast before, you know we are always talking about how important it is to have the right mentors and partners in real estate, which is exactly why I've opened up the Real Estate Investing Club online community. It's a place for active investors to learn, collaborate, and get real deals done together. And right now, it is 100% free to join. We host weekly calls where we review deals, talk strategy, and share tactics. Just click the link in the description below and come join us.
We have a strategy, which is extremely simple. If we can keep the tenant, we don't sell no matter what. And if the tenant leaves, we look at selling it versus leasing it to a new tenant. In our business, because they're single tenant buildings, the big risk is a vacancy because it's either 100% vacant or 100% leased. So we come up with what we would sell it for when it's about to go vacant. We put it on the market for lease, and we are approached all the time by buyers, even though it's not on the market for sale, saying, would you sell it? Would you sell it? So we keep a list of the names of the potential buyers. And if we don't lease it in the first 3 to 6 months, we say, how long are we going to carry this monster? A 25,000 square foot building costs $20,000 a month to carry, because we got taxes, insurance, maintenance, utilities, fixing it up. I mean, it's an expensive carry even with no mortgage. So we get to the point where if it's not leasing, we have to decide if we're going to sell it for a profit. In
okay,
2009,
that makes
yeah.
That makes a lot of sense. So yeah, if you're, especially with single tenant, if you're not cash flowing, then you sell. And that makes a lot of sense in my mind. I was more, have you ever sold a property? And sorry, we have run down the clock, so I do need to push us on after this question, but have you ever sold a property that was doing well? It was actually doing, in, I guess, my specific situation, have you sold a property that was crushing it? You had your return on equity was very low. And then you decided to sell, or if it's doing well, you always keep it regardless?
No, all of the above. Every deal is different. If we've sold 82 buildings, I could give you 82 stories, and every single one of them is different than every other one. It's like snowflakes. everyone is different. We never know.
Yeah. It is. It's hard to know when to sell. And I've sold properties, in the obverse of that, where, we had a break in, and you have to decide: do you sell and take the equity that you have right now, or do you redo the entire thing and go back through the value add process? So it's always a difficult decision, but you just hope that you make the right decision in the moment. And with that said, we have run down the clock. It is 24 minutes, so we need to push us into the quick question round. I do appreciate everything you've shared with us. I still had a lot of questions that I wanted to go through, so maybe another podcast. But I'm going to start us off here with the first question, and this is about education. It could be any form. It could be a book you've read, a conference you've gone to, a mentorship program you've been a part of. I just need 2 specific recommendations, one for general life wisdom and then one for real estate.
General life, I would say The 4 Agreements is a book that I love, which talks about how to live if you know it, it's a great book. Yeah. And as far as education having to do with real estate and business and so forth, I like Seth Godin. I like his books. He wrote The Purple Cow and he wrote The Dip, and he's on a lot of podcasts, and he talks about strategy, marketing, what people should and shouldn't do, and how to think about things differently. He's great. Yeah. 4 Agreements. I absolutely love that book. And I've read The Dip. I have not read The Purple Cow, so I'll have to pick that one up. Moving us on. The next question is for your younger self. So let's go back to the Joel who was just getting started out in 1981 with that family office. Go back to him, look him in the eye, give him one piece of advice moving forward. If you want the best life, build relationships for life. Good advice. Good advice, and something that not a lot of people say on this podcast, but I feel like, we always talk about networking and developing relationships, but we don't talk about keeping those relationships over the long haul. And that is the test of a relationship if it survives. And so great advice, especially for real estate. Next question is kind of a cop-out for you specifically, but I'm going to ask it anyways. The United States is a big place. There's a lot of opportunity out there. Give me the single metro you're most excited about investing in today. This is silly, but South Florida because of the weather. It's freezing
okay.
In Chicago in the wintertime. And I've bought a couple buildings in Florida over the years, and I'm so stupid to live in Chicago. I should live in Florida and own buildings in Chicago. But I love that. I want to buy more in that market so that I have buildings I can drive to and look at and take care of while I'm down there. I thought you were going to say Chicago, so it was not a cop-out. That's great. Yeah, we were talking before the show. I live in Seattle, so we don't have the same climate as you, but I totally understand the need to want to get somewhere a little bit warmer during the winter season for sure. All right. Next question is about finding deals. It all starts with getting in contact with the seller and penning that purchase agreement. So what is your favorite way to generate leads and find new deals? We have bought 3 buildings in the last 6 weeks from cold calling door to door in industrial parks. I had a group of 6 summer interns, and we went to one town called Wooddale, where there are 202 industrial buildings, 9.2 million square feet. We divided it up 6 ways for the 6 interns to each one call on about 33 companies every single day until they got through to the owner. And we ended up from that effort finding 2 buildings that we actually bought in that town. Damn, nice. Cold calling, you can't beat it. I've tried all the different strategies. I've tried, cold texting. I've tried email. I've tried mail. I've tried whatever, you name it. I've done it. Pay-per-click, Facebook ads, but nothing beats cold calling in my mind. It is the best way to generate leads. Cold, door knocking probably would be better, but the problem is it's hard to actually meet the seller when you're door knocking and be there when the seller is there. And so, cold calling. We wait for the Mercedes or the fancy car to come during lunchtime to the building, and then they go in the side door, not the front door, and we wait, and then we approach who looks like the owner of the company or the owner of the building. We say, "Are you the owner of the building?" One guy was carrying a McDonald's bag in, and one of my interns said, "Are you the owner of the building?" He says, "I am." He said, "Good McDonald's today?" He says, I love McDonald's. He said, would you sell the building? He said, no, go away. The guy went to him 7 times after he got to know who he was. And finally he said yes. The McDonald's
Nice.
bad guy.
Classic stakeout. I like it. All right. Next question is about lessons learned. Not every deal we get into goes the way we expect it. In fact, many times, if not every time, something goes wrong, and that's when we get to learn a lesson. So what was a deal that went a little bit sideways for you, and then what was the lesson you pulled from it?
I bought a building that was too big. We buy small buildings. It was too big, so there weren't enough tenants. There's more tenants for smaller buildings. I put debt on it. Should never have done a big building with debt. And I had a 1-year tenant who had a lease that was very short, and he could have left or stayed, and I assumed that he probably would stay. I was wrong, and he left. So everything went wrong with it, and the building sat vacant for a long time, and it was 2008, and I sold it for a loss. We bought it for $3.5 million and sold it for $2.5 million. I lost $1 million.
And the lesson there, I'm assuming, was the debt.
The size of the building, the debt, those two things. That's what we focus on now. Smaller buildings, no debt.
All right. On the obverse of that, sometimes there is things go right and you get your highlight reel. So take us to another deal, or your favorite deal, I guess, where everything kind of went right and it kind of stuck out in your mind as something you'll remember.
I bought a building in Elmhurst, Illinois from the Keebler Cookie Company. It had a gigantic parking lot, and Comcast needed a building in that area with a gigantic parking lot. And they decided that they could sign a 15-year lease, which they did. And we ended up making a 35% annual return on average for 15 years, and then sold it 2 years ago to a trucking company when Comcast left.
No. Wow, that is fantastic. That is definitely a highlight reel. All right, that leads us. Hey, but when they come, you take it. And we've said this a lot on the podcast too. Half of everything is luck. You just, it's all about volume, getting those numbers up. And then sometimes luck's going to come through the door, and you just take it when it comes. So there's no shame in that for sure. Next question is about raising money. It does take money in real estate to make money. No questions about that. So what is your favorite way to raise capital?
Referrals from existing investors. We get at least 1 or 2 a week.
Nice. I like it. And that's how you built your 300 strong investor list. And I guess it all starts with actually getting a deal done that gets a good return for those initial investors, and then the snowball starts. Yes. And that leads us to the very last question. This is for the listeners. You've given us a lot to think about. I'm sure people want to reach out, get in contact with you. This is a 2-parter. Where can they find you? And then what can they expect when they reach out?
Our website is britproperties.com, BRIT1T properties.com. And they can expect us to give them a lot of information. We have PPMs offering documents for deals that we have open. And we also, this is probably an unusual answer, everybody needs to know the succession plan of the people they invest with. What happens if the guy dies? What happens if he gets sick? Who takes over? Who's in charge? How well have you thought that through? And I will send them a copy of our succession plan.
Nice. That, you're the first person to mention that. That's very interesting. But very relevant.
I'm 66. I got to think about these things.
I get it. So I will put that link in the show notes. If you guys want to reach out to Joel, all you got to do is click the little more in the description. It's going to pull down that full description, and in there you can find his links. All right, man, that wraps it up. Thank you very much for hopping on the show.
Thank you so much.
Absolutely. For everybody who's here with us today, thank you guys for showing up. You are the reason we do this. So if you guys have any questions, reach out to me, Gabe at therealestateinvestingclub.com. If you guys want to support the show, just leave us a review or subscribe or whatever you want to do. Other than that, I hope you guys have a great week. Keep rocking real estate, and I look forward to seeing you on the next episode. All right, before I officially sign off, I have a quick announcement to make. If you're interested in becoming a passive investor in one of my deals, my own company, Kaizen Properties, is looking for capital partners for our upcoming projects. We invest in what are known as recession-resistant assets, mainly self-storage facilities, mobile home and RV parks, and industrial properties. If you're interested in investing and would like to learn a little bit more about my company, our investing criteria, and some of the previous projects we've done, go to the Real Estate Investing Club podcast at therealestateinvestingclub.com and scroll all the way down to the bottom of the page. Click on the Invest With Us button. That'll pop up the investor form. Fill that out, and we will reach back out to you as soon as we can. Or if you prefer a little bit more of a personal touch, you can reach out to me at gabe@therealestateinvestingclub.com. So really, that is it. Again, it was a pleasure hanging out with you guys during this episode, and I look forward to seeing you on the next episode.